fellow Toastmasters. So Alan Greenspan, the former Fed chairman, recently said that the current economic crisis is a once-in-a-century credit tsunami. The government had to bail out many financial institutions like Fannie Mae, Freddie Mac, AIG. So recently they pumped in $250 billion to 9 big banks. And also they gave a loan of $130 billion to AIG. So you wonder why they need to bail out AIG. AIG is not a bank, it's not a mortgage lender. It didn't give home loans to borrowers. So why it had to bail out AIG and with such a $130 billion loan? So the answer to that is the credit default swaps. So let me explain what that is. Right. Let's say I represent California State Teachers Pension Fund. I have money to invest, and I'm interested in buying insurance, buying a bond from General Motors. General Motors is issuing a bond, let's say for $10 billion, which would pay a 10% interest rate. So as a pension fund, I'm interested in investing in that, and there is some risk to that. So what if General Motors doesn't do well and it files for bankruptcy? So there is a chance that it could do that. Right? People stop buying auto loans, and buying cars, it could go down. So to reduce the risk, the pension fund can buy insurance from a company like AIG or Lehman Brothers or Bear Stearns. So basically you're buying an insurance on this bond. So you're investing $10 million in this GM bond, and if GM defaults, the insurance company is going to pay that money back. So pay that money back, right? So for that you pay a premium every quarter. So let's say you pay a premium of 1% to AIG, you still make 9% interest on that transaction. It's still a good deal. So it's very similar to auto insurance. Right? So you take auto insurance from an insurance company. If something happens to your car, so the insurance company will pay you to recover your losses. It's the same thing with these bonds. So what's wrong with that? It's like any other insurance product, right? So let's look at some of the issues with the credit default swaps. So this transaction is called credit default swap. So you're basically transferring the risk to some other company. You're swapping the risk. Credit default swap. That's what it stands for. So one of the issues is that there is no regulation in this market. So the market grew from 0 to 62 trillion dollars in the last 10 years. So if you compare that with other transactions, so like your stock market is at $22 trillion. Your credit default swap market is at $62 trillion. Similarly, the complete mortgage market is $7 trillion. And the treasury market is at $4 trillion. And also, if we compare it with the US GDP is like $14.5 trillion. So this is a huge market, but there is no regulation. So when you invest in stocks, you go through an exchange, right? So there are some rules around what you can buy, can't buy, and how much money you need to have if you are buying with a loan and things like that. So there's not much regulation on these credit default swaps. And the second issue is there is no central clearing house. So what it means is, so let's say all these transactions are done over the counter between companies. So AIG can write one of these to the pension fund and nobody else would know. Only AIG and the pension fund would know. And also AIG can sell that transaction to some other company to reduce its own risk. So it's collecting 1% from the pension fund, but let's say if the risk goes down, goes up, based on that, it could transfer that to somebody else. So in some cases the transaction changes hands 15 to 16 times. So in the end, the pension fund may not know really who is going to pay in the end if something happens to GM. So that's it. It's one of the issues with the current market. And the third issue is, so it's basically this market is like a world's biggest casino. So when you go to Vegas, you can bet on a football team saying, okay, this team is going to win or some other team is going to win. You're betting your money. You don't really invest. You don't have any direct investment in that. So you basically, so you don't own the football team, right? It's like a side bet. You can do the same thing with the credit default swaps. You don't need to own the bond or any interest in this actual transaction. You can bet that, okay, GM is going to go down, and you can enter into a contract with one of these companies that are selling these contracts. So if in fact GM goes down, you're going to get some money. If it doesn't go down, you just lose your premium, whatever you're paying. Right? It's like a big casino. And also, there's no guarantee. If you go to like Vegas and you put $10 on a black 22, you know for sure that the casino is going to pay you back your money back if you win, right? So, and there's no guarantee on these transactions. So, for example, like if your AIG goes down, there's no guarantee. There's no assurance that the AIG will have the money to pay you back. So let's see how it is impacting the current economic crisis. Right. So there are many institutions that have these contracts written all over. And also many financial institutions, they relied on these transactions, on these insurance to buy mortgage-backed securities. They invested in these home loans, pools of home loans, assuming that something goes bad, you have this insurance contract. So because of that, the market exploded, the mortgage market exploded, and the prices went up. Right. So now the banks, they don't know what exposure they have. So like Bank of America, doesn't know how much exposure it has. It knows how much exposure it has internally, but it doesn't know how much exposure some other bank like, let's say, Chase has or Wells Fargo has, because there's no central clearing house. These are done over the counter between banks, and because of that, they're not trusting each other. So before the money flows down to the actual small companies and the borrowers, the banks need to lend money to each other before they start lending to the borrowers. So Warren Buffett called these instruments the financial weapons of mass destruction. These are like rogue nukes proliferated all over the world, waiting to blow up the balance sheets of the banks. So we're going to see a lot of regulation in this market in the coming 6 months, and hopefully there will be a central clearing house so that we're going to avoid one of these credit tsunamis in the near future.